Hello, everybody, and welcome to another video again today. I didn't mean to make another one, but I found out that one of the companies, one of my small positions that I really like, has come under attack of a short report, by a short report called Muddy Waters, is the name of the report, and they're accusing D.local of fraud. And they're already setting this up to be a big back and forth argument because they do say, oh, to hide a lie, you need 1,000 lies. So saying that they're pretty much claiming that the whole company is a fraud, committed fraud. Um, and so, did local commit fraud? Maybe, maybe not. But that's why I always say in my videos, not investment advice. But anyways, I'm pretty unhappy because the stock is down 51% after it had an amazing quarter 2 days ago. And I think the market sentiment has judged dLocal, has deemed it guilty. The market sentiment is saying that dLocal is guilty, and Muddy Waters is a well-connected company. I mean, there's already hit pieces on Financial Times, on the Wall Street Journal. There's already all these pieces. The founder of Muddy Waters himself bashed dLocal for 15 minutes on CNBC, and so obviously shorting a stock, I guess you can make a small return, and good for him, I guess, that he made a return. But that really sucks for investors, and that sucks for me, and that sucks for a lot of people. And so, it really doesn't matter whether they committed fraud or not. That is my stance on this, because the likely move going forward is to most likely wait for a rebound, and these things typically have like short rebounds, especially with a 50% drop. I mean, can you believe that? That's a huge drop. To wait for a short rebound and redeploy. And I will redeploy it into Tesla because that's the position that I've researched the most, and that I spent, I don't know how many thousands of hours I spent studying Tesla. So I'll probably do that and take a loss. And yeah, there's not going to be a lot of capital gains this year, nor a lot of years going forward. That's one other conversation. Um, but anyways, why? So why do I think it's probably the best thing to sell the stock? Well, if you go to muddywaters.com, you go to their website and you look at their history, you see that they have a history of doubling, tripling, or quadrupling down on their claims. So what I think is going to happen is dLocal is going to issue a really nice point-by-point rebuttal, probably within a day or two. And then you're going to wait another week, and Muddy Waters will have another doubling down claim, and so on and so on. And if you look the way they've done this for all of the companies that they shorted, it's like it's always 2 or 3 of them. Like there's very rarely only one short report. So regardless of the rebuttal, the market is likely to vote on this, and the market is likely to vote down on dLocal. And remember, a lot of these things has to do with dark pools. A lot of trading from individual investor does not really influence stock price. So the market seems to have voted on this, and I think this will be an investor nightmare. This was a company who I think had a great CEO, a great team, and they were focused on on their emerging markets. They were focused on providing a great solution for payments. They were heavily focused on that, and the managerial attention now is going to have to shift to responding to an attack from a short seller. So again, it's very sad, but I think the most rational thing to do at this point is to like remove emotion out of it, wait for a rebound, because 50% down, there's necessarily going to be a rebound, and then sell and redeploy into Tesla, because this could last 1 year. This could last 1 year plus. And if you mix that with a appetite for risk of the market has almost no appetite for risk. So anyways, like I always say, not investment advice. But what are some key lessons from this sad moment? I think it's sad because I like the stock. I genuinely like the stock. I thought they were providing the solutions to a lot of countries that didn't have a solution. I thought some of the stuff that we were doing in Africa, for example, was very promising. So I liked the stock. So it sucks. I feel bad. I feel bad about it. But for me, what I did right is my position was only 1%. So yeah, I lost it sucks. It sucks 1%. I mean, half of 1% still sucks. There's no no way around it. Plus the time spent studying that company. Plus, anyways, it sucks. So I did that well. I was pretty happy that my position was only 1%. I was not happy about the fact that I did not have a stop loss. I should have had the stop loss. And I've had stop loss on positions before, but I've removed a lot of these stop losses because some stocks have been moving up or down 20, 25%, sometimes 30% on things that are inconsequential lately. So what if Jay Powell utters words about inflation or about the next rate hike, and then my stock is like down 20%, then I'm like out of a position. So maybe what I should have done better is do a stop loss at like 30% maybe? But then that wouldn't be that big of a difference from the 50%. I mean, 50% is an extreme case of how much a company drops when there is a short report. It's typically closer to 30% anyways. So again, stop losses are a good idea when you can have them, but in this volatile market, I think they are less relevant. And one other thing that I could have done better is be careful with emerging markets. Because when I look at all of these short reports, I see that they tend to attack or accuse people of fraud more often in emerging markets than they do in the US. At least that's my view of this. That's what I found. So they've gone after a lot of Asian companies. They've gone after quite a bit of Latin American companies, and I guess it's an easy claim to make, or maybe these companies are more likely to do fraud. I don't know, but I will think twice now about adding to Mercado Libre and StoneCo, which are two of my positions. I'll remember this. So these are some of the key lessons from this event. But what are my other thoughts? And I have a lot to say about this. I never understood short selling. First of all, I think you're betting like you're actively betting for the demise of a company. You're actively betting for fellow investors to lose money. You're actively betting for people who have spent 8, 10 years building a company for them to lose everything. That's what you're doing when you're short selling. And I guess this is more of a emotional argument, but when you take the emotion out of it, I never understood it because the max upside is 10%. The maximum upside, it's 100%. Your maximum upside is 100% when you short a stock. It's like there is an asymmetric upside by going long and by being positive. There's always an asymmetric upside going positive. So again, I never understood short selling, but that's okay. It doesn't matter if you understand it or not. The market is the market. And also, I want to say that I'm not necessarily always against short selling. I think it's useful. If there was actually fraud, I'm glad that someone can figure it out. Like, it's very useful. I'm not undermining that. It's useful that there's short report. I'm glad that we can figure out fraud and that the market can figure that out, and that there is some market research if that is true fraud, which is something that will likely take at least 1 year to fully prove, So over the long run, if they've committed fraud, I do believe they will go bankrupt eventually. Over a short run, though, the reaction of the market is purely Darwinist. It's purely about the survival of the fittest. It's purely about fighting between sellers and buyers. That's all it is. I mean, over the short term, it's all about the survival of the fittest. It's all about David against Goliath. And on this, I have a lot to say, because the market has said that dLocal was guilty. That's what the market said. Guilty. dLocal, you're guilty until proven innocent. That's what the market has said. And I guess I'm fine. Crowds are free to react however they want to a seller report. I don't have any issues with that. This is what I believe. I believe in free market. I believe in freedom. If everybody wants to believe something and sell a stock, they should be able to do so. The whole market, if they want to sell, they should be able to sell. That's what I believe. But enter GameStop. And if you've been investing for a while, you probably know what I'm talking about. Enter GameStop. Okay? Let's go back to the GameStop story. And this is so relevant. GameStop was a similar story. Short sellers were betting that GameStop would go bankrupt. Not because of fraud for GameStop, but because there was a flawed business model. And so a bunch of short sellers, Melvin Capital was a big one, took short positions, 140% short on GameStop. They were all betting GameStop would go bankrupt. And I believe that's fine, even though I would never do it. And I think it's not cool to do it, but I would not do it. I think it's fine. Like it's okay. So you want to take a short selling position, but then you need to accept the market's reaction. So I accept the market's reaction that they are killing dLocal and that dLocal is getting hurt. I accept that outcome. But when GameStop, when the market reaction for GameStop's short selling news and short news was, wait a minute, we grew up with GameStop. We all love GameStop. We talk about GameStop on Reddit all the time, and we don't like these short sellers. And when the market as a whole had a reaction, let's buy the stock, instead of let's sell the stock, the market had a sharp reaction on GameStop and say, oh, let's buy the stock. We want to buy the stock. The short sellers may be right. GameStop may go bankrupt, but you know what? We're going to buy the stock because we actually either believe in the company, either want to make sure that the company doesn't go bankrupt, because if the stock is up, the company is going to do another capital raise. So the market did say, oh, we want to buy GameStop, actually. So that's market reaction. And I'm also perfectly fine with market reaction. And so, of course, millions of retail investors bought the stock in droves. And they did that, some of them because they believed in the company, most of them because they wanted to send a signal to the short sellers in the form of a costly loss. And again, for dLocal, I'm okay with everybody selling the stock and I'm taking the loss, and that's fine. But I am also okay, I have to be consistent in myself. I am also okay when millions of buyers of stock decide to bid up a stock for whatever reason they want, beat it up. For whatever reason they want. I'm okay with that, right? Except in the case of GameStop, that didn't happen this way, did it? In the case of GameStop, you had Melvin Capital, who was on the verge of bankruptcy, which was saved by Citadel, by an investment in Citadel. And then Citadel, it's important to know that it processed trades for Robinhood and about half a dozen of other brokers. I'm just pointing that out there. And then Robinhood and others halted trading for GameStop. Shareholders were not allowed to buy GameStop. They were not allowed. And so the crux of this is it a coincidence? Is it a coincidence that the processor of most trades of Robinhood was an investor in the bailout of Melvin Capital, and that, the main customer of Citadel halted trading? Is this a coincidence? Or another question is, can you be both a market maker and a market participant? So, and I think, like a lot of people, I do believe that in the case of GameStop, the market was not allowed to continue. The rules of the market were not allowed to apply. But let's see what would have happened. Obvious to say, what would have happened if the rules of the market were left alive, were allowed to happen? So just like we are all letting the rules of the market happen on dLocal, and we're taking our loss. The other way around, it has to work. Like when a short does not turn out the way you turn it out to be, because people buy the stock in drove, and people go crazy, granted, on the internet and buy the stock in drove. And if you had major bankruptcies of hedge funds as a result of actually allowing individual investors to buy the stock and not stopping them from buying the stock. If you had allowed them to continue to buy the stock, then that would have created moral hazard for short research. That would have created a credible consequence for when you put a short research out. A credible consequence that, hey, if I put a short report out, maybe the market will not go my way. And so maybe fewer top management teams would come under attack because there is now a moral hazard associated with attacking an innovative company who I believe was doing a lot of good. And dLocal was one of those companies who I believe was doing a lot of good. You know, accessing the companies of the West, helping. Anyways, I really think dLocal was doing a lot of good. Fintech does a lot of good. Fintech is a good field. And so the rules of the market have to apply both ways. And you know, and I was never invested in GameStop. I looked at it from far away, but I definitely think this is problematic because we did not create a moral hazard during the GameStop days. A moral hazard should have been created, and it didn't. And so as long as this happens, we're going to have small companies that we love get attacked by short sellers. And again, that's okay if the market is allowed also to let it happen when it goes the other way, which it didn't, which it really didn't here. So all of this to say that the growth of permissionless, decentralized blockchains, such as the Bitcoin blockchain, I think is part of a solution to this problem. And I think that's the reason why so many millennials don't know stocks. So many Gen Z don't know stocks. So many Gen Z and millennial know Bitcoin and to a lesser extent crypto. And that is just sad. That is just sad. But you know, if you take a case of Bitcoin, nobody can ever prevent you to buy or sell Bitcoin, and it's decentralized. So there's no central party that can stop you from buying or selling Bitcoin. If our markets were like that, I don't think you would have such issues with short seller because there would be a moral hazard associated with short selling. There would be a moral hazard, and so that's all I have to say. Both markets have their issues, but I think this needs to be pointed out, and yeah, decentralizations and free markets are very important. And if you want a free market, and I think some people want a fully free market where you can trade freely, that market exists in the Bitcoin space. So anyways, second time today I talk about Bitcoin on the channel. So we'll see. I'll probably do a series on it sometime. Thank you so much for watching. None of this is investment advice, of course, ever. Subscribe and like my channel. I really appreciate it if you do that. And don't forget to follow me on Twitter at BeatTheDenominator. Thank you so much and have a great day.